The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we worked into the Thanksgiving holiday, Wednesday's trade action was mostly to the upside. Grains and oilseeds had some moderate strength into the holiday pause. Livestock, cattle futures, second day in a row of rebounds there after a really rough start to the week with all the news in the industry surrounding the Tyson plant in Lexington, Nebraska, and more. Let's take a look at these markets and talk about what we've been seeing the last couple of days. Joining us for a conversation, Mike Zuzolo with Global Commodity Analytics. Mike, happy Thanksgiving to you and your family. Thanks for joining us on the show today.
You too, Jesse. A very blessed one to you and your family and all the great listeners and viewers here on the AOA Market Talk.
Well, we appreciate you being with us as always, and a good time for us to get some insight from you too. There's a lot going on in these markets. Let's start at the grains and oil seeds, and I know we got a lot to talk about the cattle complex. We're going to save that for a little bit later in the show, but grains and oil seeds, kind of that thin, quiet pre-holiday trade, did get a little bit of a bump though Wednesday. What's your feeling as we worked into the Thanksgiving holiday across this grain sector?
Well, first and foremost, it's really important with the turn, what I would describe as short covering with some fresh fundamental news on Wednesday's trade. But we need to see a continuation after the holiday, closing out the week higher and staying strong for the sake of the technicals and the weekly charts. And I'll go into detail more on that, why, in a little bit. But I think the key here is that the market started off this week with some analysis that you and I have been talking a lot about that looked one way. And by the time we got to the holiday break, it looked a completely different way in terms of how the market viewed it. And that is the crude oil market and the wheat market. And we've talked a lot about the positive relationship between the two pretty much since spring of this year. And we did diverge a little bit last week, but that kind of came back together this week. And what led us lower, and just to put it in context for the listener and the viewer, this week's low in soft red wheat was just under 520. That's only about 30 cents away from the mid-October 4-year low. The WTI crude oil market, its weekly low made, I think it was Tuesday actually, when we were down about 2.6% at one point. They got down to 57.10, Jesse. That's only $2 a barrel from the early April low, which is also a 3 to 4 year low of around 55.12. So these two markets, as we've talked about, have been the poster children and are the key indicators, leading indicators of the oversupply commodity bias that the trade has had as we close out 2025 and go into 2026. The Russia-Ukraine peace talks only added to that mindset early on in the week and helped push the crude oil lower and therefore push the wheat lower, the common denominator being the U.S. dollar making a new monthly high on the index. I believe it was on Tuesday as well. The roles reversed on Wednesday, and the reason I think that is because we saw a lot of simmering issues when it came to Ukraine and Russia. And one of the keys, I think, has been that Ukraine has finally acknowledged they don't have the supply available in corn. They have a tighter crop. It's a crop they can't get out of the field. It's a crop they're worried about the moisture and quality. And now it's a crop that is upwards of 6 weeks of lead time at some of their key seaports versus 1 to 2 weeks. And so you throw on top of that then Wednesday's news of the Russians saying, you know what, we don't really want to do that Black Sea grain deal anymore. All of a sudden, we saw the Russian ruble jump against the U.S. dollar. And similarly, because of the Chinese purchases of soybeans, we saw the Chinese currency hit a new 13-month high against the U.S. dollar. And so that leading indicator that's been pressuring this market and holding the corn back, essentially, I think finally got let go of, and it created some buy stop opportunities on Wednesday's trade when we were able to get up to new weekly highs on the wheat and on the corn.
When you talk about the global oversupply and thinking about this with wheat and crude, and we can get into corn and soybeans in a minute, but you bring up the Russia Ukraine piece here, and let's talk about the Russian ruble versus the US dollar, some of the things you're tracking here, and how some of this financial market perspective plays into the commodity picture, Mike.
Yeah, and this is where I don't want to avoid the supply demand fundamentals of, for instance, China coming online and buying 10 to 15 cargoes of US soybeans. It was reported on Wednesday. Depending on the size of the vessel, that could be anywhere from 900,000 to a little over 1 million metric tons. That was a very needed boost in the arm. But I guess what I'm looking at and what we've been looking at together, Jesse, for the better part of a month, maybe even two, is the idea of how can we get corn, especially, which still has the lowest world stock since 2012, 2013, still has the lowest world stocks to use levels since 2014, has a potential Argentina weather market that's starting to develop. And we noticed that the Chinese ending stocks USDA took down for 25-26 by 3 million metric tons in their domestic corn numbers on this last WASDE report. How do you get corn off the ground and get it to rally when we really do think the yields are not there, like USDA said? And I think it really does start with this macro-infused fundamental and investment fund mindset that we're not oversupply. I mean, Department of Energy, for instance, is giving us a crude oil price average for the New York price, WTI, of a little over $51 a barrel. That's still $7, $8 below where we're at right now. I mean, this is where I think the trade really needs to be focused. It's certainly where I've been focused. And with this shift, all I want now is some consistency that we see the wheat and the crude oil go up together. And I think then we could probably see funds jump into this market.
Talking corn and soy, let's start with you mentioned China and the reports of some of these cargoes and more. A number of reports have been out this week I've seen from Reuters and others. And you think about the PNW price, that's usually a lead indicator, although I've seen some talk of a few vessels in New Orleans for China for soybeans. But talk about the PNW here and just some of the indicators you are seeing when it comes to this China conversation.
Yeah, I jumped to the PNW during the government shutdown because we weren't getting hardly anything out of the Gulf when it came to USDA. And so I went ahead and jumped over into the PNW. And that's been a very good move because it helped me realize that we were starting to see a real move up to the upside. And while we topped out at about 1267 on this chart, the yellow line and the blue line both, we went down to about 1233 this week. That's about 30 cents off of the highs. But notice it seems to be flattening out. And it was flattening out even as of Tuesday's close. And so when I was talking to clients and other media people, and I was asked the question, is the high in for the soybeans? I don't know if the high's in for the soybeans, but I do think, because of the South American weather especially, but I do think that the bears really wanted to press the soybean market. Why? Because we weren't seeing the numbers, and yet the Pacific Northwest price was holding above $12. And that's my line in the sand. I would not want us to go back below $12. That's that breakout point. You see that consolidation point from early November, late October. I would also say this, Jesse, the reason I'm nervous about the beans of like what can go up can come right back down again is because the sheer push to the upside that we've had here in the soybeans. I don't think it's all demand led. I think there's some supply bullishness in this because of the straight up move that we've seen. And I think this goes to the idea that we're working a seventh straight week of higher close in the weekly continuation chart for soybeans. So we're really pushing on a string right now. And we're, I think, right back to where we absolutely need not only Chinese purchases, but the wheat and the corn to come in here and support this market. And we got it on Wednesday. So I'm not going to poo-poo this market and turn bearish on beans, but I still think it is the weakest suit of cards. Why is that? Because I think China has plenty of supply, and I think they've stockpiled a lot of commodities this year.
How does some of the recent price movement affect the ratio when you look at Nov 26 beans versus December 26 corn, Mike?
Yeah, this is where if I go down the road here, and we talked last week about how the trade had pulled ahead about 2 weeks, pulled forward the South American weather, probably because both Brazil and Argentina are seeing some issues, and also probably because the longer term models are suggesting a hotter, drier bias for some key regions in both those countries. The latest like 5 to 10 day, 8 to 14 day models would suggest both countries are going to get some relief, but Argentina is probably going to be the one that gets the least amount of relief and then could turn back hot and dry, mainly in areas close to Cordoba and especially the Santa Fe province. These are areas that are representative of about 40% of the total corn crop for Argentina. I'm honing in on that early, Jesse, because we're seeing this weather market pulled ahead of us early in price action. And I'm starting to think if either one of these countries, but especially Argentina, because they're associated with meal and corn a lot of times at this time of the year, if they have a problem that doesn't go away, we've got to come back to these world stocks being so tight. And I would think that would bring in the idea by the funds, we better buy Dees corn and sell Nove beans. So that's what I want to introduce here today before the Thanksgiving holiday. And this is going to be one of our kind of stable charts that we're going to watch for the next 2 to 3 months, because notice in the green rectangle back in April of last year, we had a really big surge in 26 corn against 26 beans for new crop, led by the back end and the current Dees Nove, the 25. But now I'm wondering if we don't see something like this again, only pulled ahead in maybe January or even February, especially as we get to the base price being set for the U.S. crop insurance and the farmers out there for this upcoming year. So between the fertilizer prices, the net cash balance sheets that producers have right now, not including the government payments that should be coming, and then you throw on top of this the winter weather coming early for the United States as well, I think you've got a situation here where you're really close to needing to buy some corn acres for 26, in my view.
Mike Zuzalo with Global Commodity Analytics is our guest analyst here today on Market Talk. Let's go over and talk this cattle trade, Mike. And I'd be remiss if I didn't at least start this portion of the conversation asking your thoughts on the Tyson news with the plant closure announcement last Friday in Lexington, Nebraska. That's been the talk of the industry the last several days. It's created a lot of volatility here. We also had the cattle on feed report on Friday. So there's been a few body blows, for the last several weeks, and there's just been a lot of immense volatility here, Mike.
There really has, and I think we want to really stay on track with what you and I have talked about, and I really hit it hard last week when we spoke with Jim McCormick joining us. This is a market that is now seeing winter weather come, and I talked specifically about that last week. And so I think with both U.S. winter wheat and cattle, the winter weather coming about 4 weeks early with temperatures sub-zero in the southern plains, middle plains and northern plains. That's a big deal with this year's calf crop, especially in light of this placements table that we're looking at. So having said that, to answer your question, Jesse, I saw Monday very simply, and I talked about this and wrote about this on my blog post. And so clients and subscribers know that what I'm saying right now, I was talking about back on Monday. It was a shock and awe negative mindset because of the Brazilian beef import tariff going to zero, and also that plant issue that we were talking about, you were just mentioning. And the idea was that the Nebraska kill would go to potentially Amarillo, Texas. And then we found out that was not going to happen, and the market caught wind of that. And so we, I think, totally shelved the cattle on feed report on Monday. Tuesday, what brought us off limit, and this is, I think, really key and why I wanted to present this table to you guys, is the fact that the back end deferred cattle and deferred feeders pulled the nearby up. And so all of a sudden, the trade started to differentiate between a burdensome supply situation because of this new news and new policy decisions by the Trump administration, which I will say I haven't been the kindest about this decision to lower these beef import tariffs to Brazil. But I did find out on Wednesday that Brazil may be working on bringing in U.S.-based biofuels, and they say, quote, we're very close to working things and resolving things out. So that's a to be determined situation. That's an aside. But what I'm really getting at here is when we got to Tuesday's trade, the trade, I think, woke up to these placements numbers. And I would call this peak placements, because when you look at the weight breakdown of October 25 in the bottom graph or the bottom part of the table versus October 24 at the very top, you're talking almost all the weight groups, 10, 11, 12% less on placements this year versus last October, except the 7 to 799. I think they were down about 8.5%. But I'm going to call this peak placements, and I'm going to suggest that we are now heading towards a new drop in on-feed numbers, going back below 11.5 million by the time we get to January. And I think that is what really set the market up for the Wednesday turnaround, along with this winter weather. And there's the chart right there.
Yeah, the on feed, 1,000+ capacity feed lots. To your point, starting to see some of those moves, and so I would agree with you. I feel like we shelved the on feed report, so now we're starting to get back to some of that here in the trade. It'll be interesting to see what Friday's shortened session looks like. I want to ask you, chart wise, monthly feeder chart with all this volatility, any big changes when you look at the charts?
Yeah, no big changes. What I told clients on Tuesday night was, okay, we've got a higher close. We need follow through on Wednesday. I'm ready to buy back into this market with February and April fat cattle bought calls, known risk, not feeders. Why not feeders? Because I'm still nervous about whether we have dialed in Mexico opening their border. And that's where this purple trend line comes in on this monthly feeder cattle chart. Now, I will say also, since we're talking different countries, Jesse, I've started to do quite a bit of research, and this is where I will plug the idea. Please go to the website, pick up a 2-week trial here, because I'm going to be doing a lot of research on what does Brazil really have to offer us in terms of beef, because I found out per a report back in September that they too are starting to rebuild their herd because they culled a lot of cows and heifers for a longer period of time into the second half of this year and second half of 2025. They are almost in the identical cattle cycle as we are. Between that and the Chinese picking up a lot of the Brazilian beef, I really wonder how much we're going to get in imports. And so I think the trade could be very surprised by that when we see some of these future export sales weeks and we don't see Brazil really dialing in like they were back in the springtime before that tariff was put in place. So getting back to the feeder cattle, though, I think this is where I think the feeder cattle should have made a low at this point. And I think the worse the winter weather is, as I talked about last week, I probably got a little too zealous and talked about the doors being blown off. That probably was not a smart thing to say from a compliance standpoint. What I mean by that, though, is that to recheck the highs, to go back up into that 381 area, I think the winter weather during calving season, the way it's starting to shape up, is really a viable potential.
Live cattle chart monthly. Just looking at this here quick before we close out our conversation. Any big notes for you on this chart?
Yeah, notice the channel here drawn off the 2020 lows. This is a really important chart. And the whole time the futures were going down, it was pulling the cash, kicking and screaming lower. Now, this is a key point of the analysis that I just came up with this week. We're at 1,455 pounds live weight. I think we're max on the weights. I don't think the packing plants could take a pound. I'm being facetious, but I think we just can't take any more in terms of being able to hang these huge carcasses. And if that's the case, then the slaughter number becomes much more important than what we've been talking about, because we can't just keep adding weight. That would make also a lot of sense given we're in the wintertime. And if the winter's rough, cattle like to feed harder in the winter, but they also kind of get bogged down and have a hard time gaining too, depending on the temp. So the channel line here of support, I think, is really critical to hold here. It's just as similar to me from a trade psychology and fund standpoint as that purple support line on the monthly feeder chart. So we went down. We did enough damage, in other words, in my opinion, more than enough in supply demand. In fact, feeders lost 20% as of that limit down low close on Monday's trade this time around from its October high back in 2014, which I'm still using as an indicator and as a piece of my analysis. We only went down about 14%. So we've surpassed on the downside what we did in 2014 between October and December.
Mike, anything final that you would add or reiterate to folks here on the show today?
No, just have a great Thanksgiving and, enjoy your families. And I am, and I'm really thankful for you and what we talk about, Jesse. And I really appreciate you. And all the people that I work with. So thanks again.
Well, absolutely. And that goes both ways for sure. Always remember that risk of trading futures and or options can be substantial. Mike Zuzolo, Global Commodity Analytics. Happy Thanksgiving again, sir. Thanks for joining us.
You too, Jesse.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.